Hi everybody, this is AJ with Trading Trainer, and we are here yet again for episode number 5 of our vertical spread series. This is where we've got our special guest star, Jason Graham of the Option Workshop, leading us by the hand through all the details of vertical spreads, the 3 dimensions of vertical spreads. Let's go ahead and really get into this last episode. Jason, let's go.
Great. What I want to do this time is get really into looking at vertical skew to trade these spreads. So let's get right into it. One thing that you can do with these skew graphs or looking at implied volatility values is notice that when this vertical skew is very steep, let's look at this February skew here, very steep, they tend, probably need a different color marker on here. Here we go. Let's use yellow. They tend to flatten. One thing we haven't talked about in the previous episodes is that volatility tends to be mean reverting. So if volatility is sitting here at, let's see, it looks like it's sitting here at about 13%, and its high previous was 16, its low previous was 10. Well, let's say its high was 18, its mean was about 14. Volatility will tend to come up to about 14. Volatility tends to revert to the mean. Same thing with skew. So if you have a very steep skew, meaning very high implied volatility values for out-of-the-money puts, they'll tend to drop. Same thing if you have a very flat skew down here. If it's a very flat skew, those implied volatility values will tend to rise. So when you're selling this out-of-the-money vertical credit spread, if you can sell high volatility here and it drops, you're going to be very well positioned to make money in that trade, and that option premium is going to drop when that skew drops, even if this at-the-money implied volatility tends to stay the same, or even if it rises at some points. So a lot of the times you'll see a flat skew when implied volatility is very high and a really steep skew when implied volatility is very low. I took this screenshot, I think, before everything happened with Egypt. So this was a more steep skew and a really low volatility. If we looked at it now, this skew would be flatter and volatility would be higher. Let's take a look. The next slide here. So what I wanted to look at here was a lot of times when you talk to people that are trading vertical spreads, what they look for, this red line here is our implied volatility. This blue line here is our historic volatility. I believe we're looking at a chart of Apple. What they look for is implied volatility to be very high versus compared to the historic volatility. So they want to sell a lot of option premium versus to where the historic volatility tells us where price is moving. Usually this is a good idea. However, as we just saw, often the skew on really high implied volatility tends to be flat versus a low implied volatility like we have right now. The skew might be, I'm not saying that the skew right now on Apple is steep, but the skew can be very steep on a low implied volatility. So you might have implied volatility compared to historic volatility be lower, but trading a steep skew, you can still be trading this stock with an advantage in that you're still selling a lot of premium by selling that steep, deep, high volatility that can come down. It's not always the case, but a lot of times that's the case. Another point that we can talk about is trading different months. What we have here in green is March options. What we have here are April. A lot of times if you see a really steep skew in the further dated option, it makes a better trade than the closer dated option. So if March has, let's say it has 30 days to expiration and April has about 65 days to expiration, if we're seeing a skew in April that is similar to that in March, or even steeper, if it should be steeper, then the April is going to make a better trade, even though it's further apart. We know, even though it's further away, since we know that time decays at a linear rate for further dated out-of-the-money options. If we are trading a steeper skew, we're going to be at a better advantage. So the way to do it is to compare the volatility values of the different months and see which volatility has a relatively steep skew. Now this April has a fairly similar skew to March. So in this case, I would probably trade the April. Now, I've talked about how bear spreads can be a tough trade on my most recent blog post. What happens is, since we have a negative skew, if you're wanting to trade in the downwards direction, you're selling cheap volatility. So if you're trading a bullish spread, you're selling some expensive volatility. You're getting a good price, but if you're trading a bear spread, you're not getting that good price. So you're getting a little bit closer to price with your bear spread than you would with a bullish spread because you just don't have as much room to make enough money. And you're selling at a lower price. It can be very tough. So in this case, bear spreads can be handicapped. What a good thing to look for is to look at this skew, and if you see a skew that has this smile, people call this a volatility smile type of pattern, this can make a better trade in the bearish direction. That you can sell expensive volatility in the bearish side versus this previous slide where you weren't selling expensive volatility. Stocks that generally have this type of skew are commodity stocks. For the reason of, if you think about the price of corn, the danger of price of corn is that it can skyrocket. Let's say a big storm comes through and wipes out, the corn crop. The price of corn is going to go up like crazy. So people that are trading corn are buying calls to protect their position instead of puts. And a lot of commodity-related stocks will have this type of skew. Also, sometimes some equities will exhibit this type of skew just during the general trading day. If something some kind of funky buying is going on or funky selling, you might see this kind of skew generate itself, and that's a good point to initiate that position. Another point I wanted to talk about, we talked about how selling vertical spreads at one standard deviation gives you an 84% probability of profit. Combining that probability with some technicals, even just simply looking at support and resistance lines, which the most ardent technical analysis deniers even still will look at lines of support and resistance. If you can position a spread below these lines, you're going to be in a better position to profit. On this particular trade, I'm looking at, let's say we're making a trade. We don't want yellow anymore, do we? If we're making a trade in here, if we see price breaking out of this pattern and we decide, hey, look, this is breaking out, I'm going to put a trade on. What you can look for is, besides trading at a standard deviation away from price, you now have a line of support here where resistance once was. You have your previous line of support here or here, depending on where you see it. If you can get your spread in with your short strike here or here, which is where I actually got it on this trade, your probabilities for success are going to be that much higher. So you're working with probability and you're working with technicals. Your probability of profit just increases that much. Next thing I want to talk about, and this is what I've been talking about really this whole time, is that when you consider volatility at the beginning of the trade, your longer dated trade is going to perform better than your shorter dated trade. And I'm going to show you an example here of a trade that I did. Opened it on January 12th here. This is on DE, John Deere. Right here is the opening of the trade. Did these two as an example. I opened a February 75.80 bull put spread. I got 46 cents. This was a credit spread, a margin of $4.54. At the same time, I opened up a March position. Same spread. Got 74 cents on that spread on $4.26 of margin. Position, I think this is something like 20 days later, and that's including weekends, but I mean, you can see on the chart, it's not too long later. Here's our spread right here. That's what these lines are. I don't know if you can read this or if it's too small or not, but this is our 80 put and this is our 75 put. On February 1st, this February spread was worth 9 cents. So we made a profit of 8%. This March spread, remember, traded at the same time, same strikes, was worth 27 cents. But we sold it for 74 cents. So we made a profit of 11%. Just an example to show when you consider volatility at the beginning, you can make more money with the longer dated spread. So to summarize what we've been talking about, the half condor combines probability theory with a directional bias to generate a consistent amount of income on a semi-monthly basis, 15 to 20 days, sometimes 30 days when things don't go right. Shorter dated half condors, I should put that in quotation marks, or vertical spreads, out of the money vertical spreads, decay slower than longer dated vertical spreads. However, the risks of the longer dated vertical spreads are that you have price and volatility that can work against you. We can address price risk by trading on swing entry signals, by positioning our spread at one standard deviation from price. And we also talked about how that one standard deviation mark can be used, your volatility assessment that you use to place that standard deviation or to create that standard deviation can change depending on your view of that vertical skew. Or we can also position our spread, we can also position our spread beneath different lines of support and resistance, or resistance in the case of a bear spread. We can minimize volatility risk by analyzing the skew. And if we trade a steeper skew, we're going to be in better shape to trade that vertical spread. And that's all I've got for you.
Excellent. That was a fantastic series and a fantastic summaritic, if that's a word, summary episode on volatility and how it works with vertical spreads. I loved how the outcome was that it really works when we're doing these out of the money vertical spreads. That if we take a little bit of extra time and do a little bit of technical analysis on the price chart, or even just look at things like support and resistance lines, as well as analyze the volatility and look at skew, we can really position and pick the right options to option components of our vertical spreads to really make it profit a lot more. I mean, though that 3%, it might just be 3%, but we're talking about 3% extra that you profited in a given month or in a given 15 to 20 days. Jason, I really, really appreciate all the time you've spent with us over this serial, and I definitely liked today's episode. Any last comments before we call it a quits?
I just appreciate you having me, AJ. It's great to do this kind of thing. And
all righty then. Fantastic. Well, everybody, that was our serial on the options of a vertical spread, specifically on vertical spreads. We had Jason here with the Options Workshop, and that's all we've got. Everybody, please take care.